Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Justwealth, investing the way it should be, just for you. And welcome back to the Just Word Podcast. You know, a couple of decades ago, there was a great TV show called Mythbusters. Well, we're going to do kind of one of those things, debunking some investment myths with James Gauthier. He's the Chief Investment Officer at Justwealth Financial, and he joins us right after this word from our sponsor. James, great to see you again.
You too, Pat. Good to be here.
I guess you've become our official Mythbuster.
Well, let's hope so.
All kinds of myths in the investment industry. And one that's particularly pertinent right now, because it is May, is the old sage, sell in May and go away. What do you think about that?
Yeah, people love to have phrases that rhyme. And that's a good rhyme. I'll give it that. It's a great rhyme. And people have been saying it forever. And it really goes back to, people found out that market corrections tend to happen, or at least the bad ones have tended to happen in the months of September and October. So people that, typically go on vacation in the summertime would say, well, you can just sell things in May and go away and then come back after the drops and then buy stuff cheap in the fall or the winter, whenever you get around to it. So there is kind of a rationale to why people would say something like that. And if you historically test returns backwards month over month, there is a slightly higher performance between the months of November and April compared to May to October. But the performance returns from May to October are not negative over time. They're still positive. And what the phrase suggests, sell in May and go away, is basically you should time the market. That's really what it's suggesting. And most people would know if they do any research or find credible studies. Everybody should know that market timing does not work. And it doesn't matter how many times you say it or how many times you read it, people still do it. It's bad for them. But, sometimes you just can't fix every problem.
Well, and the lows in the marketplace aren't necessarily guaranteed to be in the fall in the first place. And then getting the exact day right is almost impossible. You got to be in the market all the time to get all the ups, don't you?
That's right. I mean, if you stay invested in the long term or time in the market, you will come up ahead as long as the markets continue to go up, which historically they always have. Suggesting to get out of the market for a short period of time is not great advice, whether it rhymes or not.
Okay, so the next myth is that now is a good time to buy GICs. And I'll admit, guaranteed investment certificate sitting at 5% is a pretty attractive return over the short term. What are your thoughts on that? It's not really a myth, but maybe a rumor.
Yeah, it's topical. We see it. We see people asking, how are you going to beat GIC returns? Well, here's the thing with GIC returns. GICs tell you the return in advance of actually making your investment. They tell you up front, you're going to make 4% for 1 year or 3 years or 5 years, whatever the term is. So it is guaranteed as long as there's no bankruptcy and you have more than what's insured by the CDIC. It is a guaranteed return. But what they don't tell you about GICs is that your liquidity is gone, the money you can't touch, or you're going to have to take a significant penalty in terms of the money that you make. It's taxed at your highest marginal tax rate, if applicable. And then you run into reinvestment risk. What do you do when the term is up? If interest rates go down between now and the maturity of the GIC, you might get 4% now, but you're stuck getting 1% in the future, like it's been the past several years. So there's all kinds of risks and inconveniences that come with it. And the trap that people fall into is looking at historical returns from other investments, say, a mutual fund or an exchange traded fund. They say, this has made only 2% in the last 5 years, but I can get a 5-year GIC going forward for 4%. That's an easy decision. But you're not comparing forward-looking return with a forward-looking return. You're comparing a forward-looking return with a backward-looking return. You can't change what's happened in the past. And there's no guarantee that a 4% return in a GIC is going to be any better than what that comparable product you're looking at might be. That might be going to get you 8 or 9% because it's coming off of a poor period. So it's likely to have a good period going forward, because in the long run, GICs will always be the lowest return. So it's never good advice to recommend investing in a GIC.
Yeah, and looking at those long-term returns on the TSX Composite or the S&P 500, you're looking at 7, 8, 9%. I mean, it depends on the index you look at, but significantly higher than what you're getting in those GICs. Interesting.
And
Okay.
bonds are higher too.
Yeah, good point. Here's one that I'd love your opinion on. The trend is your friend, meaning the stocks are going to go up, they're going to continue to go up, and vice versa, I suppose. If they're going down, they're going to continue to go down. What do you think?
Yeah, there's could be two interpretations for that. So the trend is your friend. Yeah, it's technically referring to technical analysis, which says, the momentum is always going to work in your favor. And that's the way momentum traders or momentum investors work. They keep buying things on the prospect that things will go higher or the trend will continue. But inevitably, every trend will change course. It will, go the other way. And it always comes without notice and without expectation. So for those people that get in late on the trend, they're just setting themselves up for a hard fall. So trend investing is no really better than any other type of investment strategy. It works for a while and then it won't work. In the long run, it's probably going to generate the market return, and you're no better off because of it. And if it's forcing you to have turnover or get off your other strategies that are more proven for long-term investing, then it's probably not a wise idea. The other interpretation of a trend would be more like a fad or buy what's hot. So not necessarily one particular investment, but a theme like cryptocurrency or cannabis stocks or technology stocks in the 90s. Jumping into these fads or trends, right at the wrong time when a bubble is forming is another way to set yourself up for a complete disaster. And it's quite topical that you asked this question today, because for the first time, I saw advertised on CNBC this morning a new ETF offered by some American company investing in AI. So AI is the latest buzzword, and anybody who's followed the tech sector would know that it's generated some pretty good returns so far this year. And now everybody's hopping on. The products are going to start coming out. You got to get in an AI. You got to buy the AI ETFs. You got to specialize, put everything into AI because that's the future. Well, all these wonderful promises will work until they don't. The bubble will burst, and then eventually people are going to lose money. So never, never, never get caught up in these trends, because it will always result in disappointment.
Artificial intelligence leading to artificial results until the rug's pulled out of the from underneath you. Okay. Not only are you a money manager, you're a portfolio manager. So how about some comments that and myths that are associated to portfolios? In particular, things like lower fees mean higher returns.
Yeah, well, returns are or at least they should be if they're done according to industry standards. Returns are produced net of fees. So anytime you see returns published in a newspaper or the internet or any other media source, those returns should be stated after fees. So it stands to reason if you have higher fees, that's going to be a bigger hit on the performance of the funds. Mm-hmm. And there's a lot of commercials and advertising and competitors of ours that are out there advertising saying, trust our low fee approach. Don't pay high fees because it's not going to benefit. Well, the fact is, in our case, Justwealth, it's worked. A low fee approach has resulted in industry leading returns, but others have not had the same results. Some of the other online competitors, which have the same low fees as we do, charge a very low fee, invest in the same types of products that we do, exchange traded funds. They have returns that are below the high fee products. So you really have to be careful. It's not just about fees. Low fees do not guarantee higher returns. High fees will cost more, but you might be getting in an inferior product by investing with something with low fees. So you have to be very, very careful. What do the lower fees mean? Are you compromising on something else? So always be sure to look and compare and do your homework, and don't just take some marketing verbiage for it.
Okay, here's one that might be closer to your heart, near and dear. The 60-40 portfolio is dead. In other words, 60% in stocks to get your growth and 40% in bonds. Is it dead then?
No, it's alive and well. So 60-40, I mean, that is the typical balanced portfolio. It's the most commonly selected portfolio. It's an average level of risk. It's which, most pension funds tend to invest around it. It's just very appropriate for a large proportion of investors. Some might be more aggressive, some might be more conservative, but every once in a while, people that offer products that are not part of the standard portfolio or alternatives like to say the 60-40 is no good. You need to get into alternatives, which are typically higher priced, and they're making marketing pitches to try and sell their products. And most people who are traditionally invested in 60% stocks and 40% fixed income don't really know about alternatives. So for them to try and get in and get a piece of their pie, they just say 60-40 is dead. And the timing of all of these comments are coming right after a year, 2022, where both bonds and stocks were down. So this is the kind of the case where they're trying to be opportunistic and trying to strike while the fire is hot. When bonds and stocks both did poorly, that's the best time to introduce, well, you got to invest in something different. And just so happens, we've got all these alternative products like real estate or private credit or private equity. There's all these asset classes where they're charging big fees to try and get your assets. And the returns that they produce, because they are private, a lot of these alternatives, hedge funds fall into this category as well. They're not regulated the same way as public equities, the stocks and bonds, which are public securities. They're marked to market daily. So they have a very clear track record. Everything is traceable, and the accounting for everything is up to standards. Private is not regulated the same way. It's based on, in the case of real estate, quarterly valuations. So the prices never change, and it looks like a very stable investment. But if you compare a building in a private real estate fund and a building in a public REIT or a real estate investment trust, the price of the real estate investment trust building goes up and down all the time because it's marked to market daily, versus the valuation in a private fund. It doesn't change. So it looks like a stable investment, but it's subject to the same pricing conditions, liquidity conditions, and everything else. So apples to apples, you're not making the same comparisons. And to try and make some of these arguments that they should be displacing traditional assets is completely false.
Okay, but to be fair, the 60-40 is not dead, as you indicate, but it can be tweaked a little bit. In other words, depending on your age, you might have more in bonds or stocks, but we're talking, 50-50 or 70-30 or something like that, aren't we?
Well, I mean, there's a natural progression of the risk that you take in your portfolio. So yeah, over time, your asset allocation should change. When you're a bit younger, maybe you should be 80-20, a little more aggressive, more stocks in the portfolio. As you get older and you can't really take the risk because you're dependent on the income, you might shift to more fixed income to the 40-60. But I think the 60-40, all the companies that are saying 60-40 is dead are alternative asset providers. They're the only ones saying this. It's not anybody else. And it's, like I said, they're kicking a horse when it's down, because you're coming off the year 2022 where both stocks and bonds were down. So they're trying to be opportunistic. If you look at longer term returns, so even with the bad year of 2022, both stocks and bonds down, portfolios, the 60-40 was probably down about 10% in 2022. If you look at 5-year returns, they're still 6.5%, 7%, depending on the provider. That's exactly what you would expect long term. So don't get hung up by the need to get into alternative products that are expensive and not necessary.
Okay, I saved the last and the best. Active versus passive investing. Let's define those first. Active being an active manager that changes on a day-to-day basis or not, and passive meaning an index. the Standard & Poor's 500 or the TSX Composite. Is that a fair definition?
Yep, that's pretty accurate. What I would say is, I mean, passive attempts to replicate a market return. So the S&P 500, if it goes up 10%, your passive return is going to be 10%. If you're an active investor, however, you're attempting to beat the market. So you're going to be different than the market. You're going to make a bet on something. It could be a sector, it could be a stock, it could be an investment philosophy, it could be a trading strategy, it could be any combination of those. But the idea is active is different than the market, and the attempt is to try and beat it. So I'm not sure what the myth is here, but
well, the active managers would say that they beat passive on a consistent basis. And I don't know how that's possible, given that the fees to have an active manager might be higher than just an index replicator.
Yeah. So, I mean, if you watch any commercial from an investment provider, they'll say, our research process or our proprietary way of valuing stocks adds value. So it's a lot of, wordsmithing and a lot of promise and like they can't say anything illegal or make guarantees, but they can say all kinds of things that make you think that they're going to add value to the market return. The empirical evidence consistently over time has 100% proven that it is not true. So there's an organization called the Evidence-Based Investor. It's run by a guy named Robin Powell out of the UK. And so evidence-based investing is very much what we believe in. And he came out, I'm going to say about a year ago, and said, the debate is over. I am not going to talk about this anymore because there is no evidence whatsoever that active management adds any value. Every single credible study will show that passive management delivers better returns in the long run. But every commercial you see says the exact opposite. So I don't think it's ever going to change. The marketing's never going to change. I mean, obviously, an active manager is not going to come out and say, sorry, we can't beat the index, but buy our funds anyways.
No, they're not.
It's not going to happen. No. But, and as long as they're not saying anything illegal, regulators will allow it to happen.
But there's another myth that you just busted, James. Thank you.
My pleasure. Love doing it.
James Gauthier, Chief Investment Officer at Justwealth Financial.